Imagine this. The markets are collapsing. Headlines screaming 2026 crash everywhere. Panic. Fear. Your portfolio bleeding. Now imagine you're looking at the same crash and smiling. You're seeing opportunity, not just loss, because you know something the crowd doesn't. Hi, welcome to our channel. If you want to turn fear into fortune, stay tuned. And hey, before we dive in, hit subscribe and ring the bell so you don't miss how we use crises to build wealth. And below in the comments, tell me, what's your biggest fear when the market turns south? We're going to tackle that. Today, I'm going to walk you step by step through how you can use the expected 2026 market crash to get rich. Not maybe get by, but build serious wealth. We'll talk strategy, timing, mindset, real-life examples, and mistakes to avoid. Let's get started. Why a crash is not just destruction, it's opportunity. You've heard it before, markets crash, stocks plummet, panic sets in. But here's the thing, in every major crash there were investors who used it as the launchpad for massive gains. Take the crash of 1987, Black Monday, 1987. The Dow Jones Industrial Average fell about 22% in a single day. Sounds terrifying, right? But for a prepared investor, that drop created value-priced assets. Or look at the 2020 crash triggered by COVID-19. Many long-term investors who stayed calm saw full recoveries. The takeaway? A crash doesn't just take money away, it creates discounts. It forces sellers, it shakes out weak players. And what remains are opportunities for those who act wisely. So when you hear 2026 market crash or bear market incoming, don't freeze, don't flee. Instead ask, where is the value? Where is the bargain? And yes, you can get rich from a crash. Not overnight, maybe not without risk, but with planning and discipline, absolutely. Now let's turn this generic idea into a specific plan. Because get rich in a crash sounds good, but without structure, it's a lottery. Step 1. Build your foundation before the crash hits. Here's the first rule. You prepare before the storm. If you wait until the market is already collapsing, you're too late, or you're panicking. So what does preparation look like? Ensure you have an emergency fund. You're not investing money. You might need this week, because if you need that cash and you're forced to sell during a crash, you lock in losses. Know your numbers. Identify how much you can allocate to risk assets versus how much you must keep safe. Long-term horizon? Great. Short horizon. Adjust, diversify truly. Not just, I have 10 stocks, but across asset classes. Stocks, bonds, maybe real assets, maybe cash. Because in a crash, many assets move together. Have a cash ammo bucket. When things go south, you'll want dry powder to deploy at the right time. Many investors regret not having this. Decide ahead. When things turn south, what will you do? Sell, hold, buy. Outline your strategy so you don't panic. If you do this groundwork now, a crash becomes your opportunity, not your tragedy. Comment below, what preparatory step do you still need to do? Let me know. Step 2. Recognize the 2026 crash signals. We're assuming a crash could hit in 2026. Why deep cycles, plus leverage, plus valuations, plus global shocks? These are tipping points. You don't need to predict exactly, but you can watch for warning signs. For example, broad market valuations are extremely high, economic data weakening, lots of margin leverage in the system, rising interest rates, and credit stress. And importantly, when everyone is sure things will keep going up, that's often when the market is most vulnerable. One rule: when every expert agrees, something else is likely to happen. When you recognize the signals, one of two things happens. You get ready to act, or you step back and protect. For our get-rich plan, we lean toward acting, but smartly. Step 3. Deploy during the crash. Buying smart, not blindly. Now the crash happens or is unfolding. Market dropping. Fear everywhere. You're watching. You're ready. This is your moment, but you must act with discipline. Here's how. Focus on quality. Good businesses with solid fundamentals will survive. You want ones that fall because of market panic, not because business is dead. Use dollar cost averaging, DCA. Instead of dumping all cash at once, you can buy in increments as things fall. This smooths your entry price and prevents huge timing mistakes. Avoid panic buying. Just because a stock drops 50% doesn't mean it's a bargain. It might still be broken. Do your homework. Think long term. You're not looking for a 1-week flip. You're looking for 3 to 5 to 10 years or more. The bigger the crash, often the bigger the eventual recovery. Add to winners. When you see companies or assets you believe in, add when they're on sale. As one investor on Reddit said, cash is locked and loaded. The idea is to buy quality stocks on every 3 to 5% market drop. Ignore the noise. Headlines screaming market crash or end of world are normal during a crash. They're not your signal. Your signal is value plus preparation. Real life example. Someone with $10,000 cash ready sees stocks they like drop 50%. They allocate $2,000 now. $2,000 in a month. $2,000 next month. Over time, they get a far better average price than someone buying only after the fear subsides. Step 4. Turn the crash into wealth. Strategy variance. Let's talk about specific strategies you can use during, and after the crash to build wealth strategy. Buy the dip and hold for decades. You buy solid companies or ETFs when the market is crushed. Hold them for years. When others flee, you buy. When the market recovers, you benefit. This is low maintenance, requires patience. Pros: less trading, less stress. Cons: requires conviction and time. Strategy: B. Value investing in the crash. You hunt down those rare bargains, solid businesses whose share price drops far below fair value. You evaluate fundamentals, margin of safety. You buy, then wait. This is what legends like Warren Buffett do. Recently, a commentary on Buffett's crash approach said, "Buying quality businesses at discounted prices while others panic." Pros: potential for high upside. Cons: requires skill and patience. Strategy C. Deploy diversified crash-ready portfolio. Here you build a portfolio designed to do well in multiple scenarios. According to Ray Dalio at Bridgewater Associates, rather than trying to time the crash, you build 15 uncorrelated, risk-balanced return streams. That means your portfolio isn't relying on just stocks recovering. There may be alternatives, commodities, real estate, etc. Pros: better risk control. Cons: more complexity and may require more capital or knowledge. Strategy D. Speculative, high-risk, high-reward plays. You pick assets that are being oversold, perhaps companies near bankruptcy, but with a good chance of revival, or short options or other vehicles. This is high-risk, high-potential reward. For most people, this is optional and should be limited. Pros: big upside. Cons: big risk. Pick the strategy that matches you. But here's the key. You need a plan, you need to commit to it, and you need to execute when the time is right. Step 5. Managing risk. Because crash doesn't mean no danger. Important. A crash is not a free lunch. There are risks. You must manage them. Don't go all in with all your cash. If you use everything and the market falls further, you'll be hurt badly. Avoid margin leverage unless you know exactly what you're doing. During a crash, liquidity and margin calls kill many. Rebalance when you need. If a certain asset is overweight, you might shift. Maintaining allocation helps. Keep an emotion check. Fear and greed are stronger than long-term resolve. For those holding through the crash, don't watch the portfolio every minute. Volatility will create stress. Staying calm matters. If you invest blindly, you could buy falling companies that never recover, so due diligence remains essential. Step 6. The after-crash advantage. What happens when the market recovers? Here's the beautiful bit. When the crash ends, the rebound can be huge, but you'll only benefit if you're invested. Some key points. When many sellers capitulate, the supply of assets drops. The buyers who remain set the stage for the next bull run recovery often comes faster than people expect. In the 2020 crash, the broad US market recovered much of its losses within months. Those who bought quality during the crash time are sitting on massive gains in the years after. If you hold for the long term, the compounding effect kicks in. The sooner you start when things are down, the more you benefit. Put differently, a crash is like a sale. When the store is offering 50% off, you don't wait for full price. You buy, then you wait for it to come back. Real life example walkthrough. Let's walk through a simplified hypothetical with you. You have $50,000 investment budget. You allocate $20,000 to your crash opportunity fund. You prepare as per step 2, diversified with cash bucket, etc. Then in early 2026, you see weak economic data, high valuations, warnings everywhere. You deploy $5,000 into Company X, solid business, $5,000 into an ETF of quality stocks, $5,000 into real asset, for example, real estate fund. $5,000 stays cash for next phase deployment. The market drops 30%. Your holdings drop too. You don't panic. You deploy second tranche of $5,000 into Company X again, lower price. Another $5,000 into the ETF. Now you're in with $20,000 across these assets, average cost lower. Over next 3 to 5 years, the market recovers, Company X doubles, ETF grows, real asset rises. You're looking at maybe $40,000 to $60,000, depending on returns, instead of being stuck at losses. In real life, you'll vary the amounts, the assets, the timeline. But the principle remains: buy when others are fearful, hold with conviction. This part is as important as the numbers. When everyone is panicking, you must think differently. Here are mindset tips. See the crash as your opportunity. Not just the market's failure. Be patient. Wealth takes time. The crash is moment. But recovery, growth and compounding are what build riches. Stay curious. Ask why, not just what. Why is this business still standing? Why is the price falling? Accept that you'll be different. While others sell, you buy. That means you'll resist the crowd. That's okay. Focus on long term, not the next hour or next day. When you invest in a crash, you're buying years ahead. Don't chase the shiny new thing. During crashes, lots of hype and fear swirl. You don't need to gamble. You need to pick wisely. Common mistakes during a crash and how to avoid them. Let's be real. Many people go into a crash with good intentions and come out broke. Why? Common mistakes. Mistake: panic selling. When markets fall, people freak out and sell cheap. That locks in losses. Instead, if you believe in the asset, hold or even buy more. Mistake: blind buying. Just because something is cheap doesn't make it a good investment. Research matters. Mistake: thinking, it's different this time. Yes, every crash has unique features, but human emotions and market mechanics repeat. Mistake: ignoring risk or goals. If you need your money next year, don't treat it like a 10-year investment. Mistake: waiting for the bottom. Trying to time exactly when the crash ends is a dangerous game. Better to act when you see value. Mistake: too much leverage. Margin amplifies losses in a crash. Avoid unless you are highly experienced. When you avoid these, you increase your chances of not just surviving the crash, but gaining from it. Before you finish watching this video, write down these 10 points. Use them as your crash wealth blueprint. 1. Emergency fund in place. 2. Cash bucket ready for deployment. 3. Asset allocation diversified across classes. 4. Quality assets identified, businesses, funds, ahead of time. 5. Entry plan for crash scenario, how much to invest when, how you'll scale in. 6. Risk plan, max loss you can tolerate, stop loss or mental exit criteria. 7. Mindset discipline, buy while others fear, hold while others doubt. 8. Avoid leverage unless you know exactly. 9. Avoid trying to time the exact bottom. Focus on value. 10. Long-term horizon. Commit to holding, compounding, and patience. If you fill this checklist today, when the crash comes, you'll be ready. If you don't, you'll be reacting. And reacting is expensive. If you're finding this video helpful, hit the like button. Subscribe if you haven't yet. In the comments below, tell me, what one asset or company would you be ready to buy during the crash? Let's discuss. I'll reply, all right, let's wrap this up. You've seen how a market crash isn't just chaos. It's opportunity. You've seen how to prepare, how to act, how to avoid danger, how to turn a downturn into a step up. Remember, the crash doesn't make you rich. Your actions during and after the crash do. It's not about timing the bottom perfectly. It's about being ready, recognizing value, deploying smartly, and holding with conviction. Let me leave you with this. The next time the headlines scream, market collapsing, I want you smiling inside. Because you'll know that while many are scrambling, you're building. While many are selling, you're buying. While many are fearful, you're calm. So take this script, take the checklist, and prepare now. When the 2026 crash happens, and yes it may, you won't be caught flat-footed, you'll be in position. And you'll be ready to get rich. Thanks for watching. Don't forget, drop your comment, subscribe, and share this video with anyone who needs to turn fear into fortune. I'll see you in the next one. Stay sharp, stay ready, and let's build wealth together.